Hi, everyone. Thank you for joining us for today's webcast, Sprott's 2020 Vision on Gold and Gold Stocks, sponsored by Sprott Asset Management. Today's webcast will be providing one CFP, one CEMA, and one CFA CE credit. If you have any questions on credit, please don't hesitate to give us a call at 704-540-2657. We welcome any questions you may have at any point in time during today's webcast. You can type your questions in the Q&A box to the right of the slides, and we'll do our best to get to as many of your questions as possible. In the event your question is not answered during today's event, a member of the Sprott Asset Management team will get back to you directly. We have made materials available for you to download in the Documents folder at the bottom of your screen. As always, we appreciate your feedback and are striving to make these events the best they can be for your viewing satisfaction. So, at your convenience, please take a moment to take our survey. It is also located at the bottom of your console. We will cover quite a bit of information during today's webcast. If at any point in time you are interested in scheduling a one-on-one meeting with Sprott Asset Management, please click the one-on-one folder at the bottom of your screen and confirm the request. In the event you missed any part of today's webcast or simply would like to watch it again, a replay will be made available and all registrants will receive that information by email. Today we are joined by John Hathaway, Douglas Groh, and Ed Coyne. John joined Sprott Asset Management in January 2020. Mr. Hathaway is a portfolio manager of Sprott Hathaway Special Situation Strategy and co-portfolio manager of the Sprott Gold Equity Fund. Doug joined Sprott Asset Management in January 2020. He serves as a co-portfolio manager of the Sprott Gold Equity Fund as well as other investment vehicles in the Sprott Gold Equity Strategy. Also, Mr. Groh earned his BS in Geology and Geophysics from the University of Wisconsin-Madison and an MA from the University of Texas at Austin. Ed joined Sprott in January 2016 and has more than 25 years of investment management and sales experience. So with that, I'd like to go ahead and turn it over to today's moderator, Ed Coyne, Senior Managing Director, Global Sales for Sprott Asset Management. Ed?
Thank you, Natalie. Well, welcome everyone to today's call. It's always nice to have a call where the asset that we're talking about has been off to a nice start. It's up over 4.5%, actually 5% year to date, and it's broke through and seems to be holding above 1,600, so we're happy to see that. For those of you that aren't familiar with Sprott, I want to spend a few moments giving you a quick high-level overview on us as a firm, and then talk a bit about the market, what we've seen really over the last couple of years, and dovetail that into what that means for both gold and gold equities. And then I'll turn it over to John Hathaway to talk specifically about gold as a core allocation, and then Doug Groh to dovetail into gold equities as a more opportunistic allocation. And then we'll tie it all up with some Q&A on the back end. So for those that aren't familiar with Sprott, Sprott has over $11 billion in assets under management and is one of the largest asset managers in the U.S. Market. Is in the U.S. market. What's unique about Sprott is that the $11 billion we have under management is all focused on precious metals and real assets. We have a large breadth of our focus from the physical side to the equity side, all the way through to the debt and lending side. We're a publicly traded company, and we trade on the Toronto Stock Exchange under the ticker symbol SII, and we also trade on the over-the-counter under the ticker symbol SPOXF. We have a market cap of north of $600 million, and over 20% of our ownership is held by insiders. We're headquartered in Toronto with approximately 130 professionals and 5 offices across the globe, and over 25% of our investment professionals have mining-related degrees. From a product standpoint, we've got, as I mentioned, over $11 billion in assets, but what's unique about our firm is we really take an investor through the entire precious metals process. We offer a suite of solutions in the physical side with over $8 billion in assets. We give clients exposure to physical gold, a basket of both gold and silver, pure silver, or a basket of platinum and palladium. We also have a suite of factor-based ETFs that gives you exposure to large cap mining stocks or seniors, and we also have a factor-based ETF that gives you exposure to the juniors or the small cap space. In addition, We have an active portfolio that we recently acquired from Tocqueville Gold strategy and their investment team, and have created our flagship mutual fund, the Sprott Gold Equity Fund, with a ticker symbol Sgdlx. In addition to our physical and equity, we also offer a suite of private solutions both on the equity side and the lending side, and have a brokerage service as well for those investors that want to allocate to individual securities. Now, as I mentioned, we just recently acquired the Sprott Tocqueville Gold team and its strategy. And what's unique about that acquisition, which we just closed on in January of this year, is the combined strength of our established team at Sprott, as well as the combined strengths of the established team at Tocqueville, have built, in our view, a powerhouse firm, frankly, that focuses on precious metals and real assets. We believe we are the true industry leader in this space, with over $11 billion in assets between the physical, equity, and debt and lending strategies. Sprott offers a complete spectrum of ways to allocate to the space. And we've gotten deeper bench strength with the research side, the analyst side, the buy-sell side, as well as the product suite side, both from a support standpoint and from an asset management standpoint. And on the following page, I just want to give you a quick snapshot of the Gold team itself. Whether it's the investment team, the technical advisors, or the executive team, we've got tremendous breadth, strength, and history and track record of a full professional staff. And to close, the Sprock Gold Equity Strategy, which was founded back in 1998, has currently over $1.8 billion in assets through the end of the year. And for those investors that are interested in the allocation, we offer mutual funds, separately managed accounts, private funds, and for qualified purchasers, customized solutions. So with that as the backdrop, I want to now shift gears a bit and talk about the market opportunity. And this is really to talk about what we've seen more recently in the market and what that really means for you as an investor when allocating to both core physical gold as well as thinking about gold equities as an opportunistic allocation. The first thing is really, why does anybody care? You know, I think it's interesting. We have over 730 people registered on the call today. We've got north of 20 questions that have already come in, actually 24 questions that have already come in. So clearly people are starting to pay attention. But I think one of the things that we have noticed is that the typical retail investor, frankly, doesn't care. And I think largely it's because gold really hasn't done all that much since 2011, albeit the last couple of years it started to really shine again, which we're going to certainly talk about today. But if you look at the last decade or so, gold's been largely flat. In fact, cash has even outperformed it. But for those that have a better recollection of what gold's done in previous market cycles, the prior decade, gold was truly king. It was up over 15% on an average annual basis when the S&P delivered a return of basically flat. It was up about 40 basis points. In fact, the S&P underperformed even bonds. And so in times of stress or times of dislocations or recalibrations in the asset markets, gold tends to do quite well. And in the modern era of investing, on page 11, I think when you look at what gold's been able to deliver, it's been quite impressive. Most investors are surprised by the fact that gold has delivered north of 8% on an annualized basis, and the S&P has been slightly above 6%, even with the robust returns it's had over the last couple of years. And it really stands to reason that we're not here to say gold should replace your entire portfolio, but in the current market environment and what the return patterns have been in gold over the last 2 decades, with access to mutual funds, closed-end funds, and ETFs, gold today is one of the most liquid, low-cost solutions to help buffer potential volatility in the portfolio. And when you see what it's been able to deliver the last 2 decades, I think now is a good time to be thinking about allocating to both gold as a core and gold equities as a tactical. Now, one thing that I think is worth pointing out before we get to John Hathaway to talk about really real opportunities in the physical gold market is what we've seen clients start to do. And when I say clients, it's been mostly at the higher end of the spectrum, big institutions, state endowments, universities, large private family offices, and so forth. But what they're starting to do is look at gold really as an addition to, or in some cases, a replacement of their bonds and cash in their portfolio. Now, historically, gold has been viewed as a way to buffer potential volatility in equities. But more recently, with rates continuing to be flatlined and in some cases still negative, particularly overseas, gold is starting to be viewed not only as a buffer to your equity exposure, but also as a replacement or as an addition to your bonds and in some cases your cash allocation in your portfolio. And last year was no exception. Gold had a nice return of over 18% when bonds delivered just slightly north of 8%. And this really has started happening over the last couple years. If you look at page 13, it really highlights the last 4 years of returns of physical gold relative to bonds. And I think this really started to happen when the Fed announced they were going to start tightening again in 2015, the fourth quarter of 2015. And albeit they had some success in early days of tightening, we certainly remember what happened in the fourth quarter of 2018 when the market started to realize that enough's enough. And in fact, last year, as we all know, they started to ease again. And so in that type of environment, in a low-rate environment, we continue to see more and more investors looking at gold as not only a buffer to their equity, but as a potential replacement to both their bonds and cash. And this is also in the face of an extremely strong 2019 for the S&P 500. As we all know, hopefully most of us participated in a 31% plus return in the S&P, yet gold still was up over 18% last year. And I find it interesting that not only on a year-to-date basis of 2020, gold's outperforming the S&P by about 100 basis points. Over the last 12 months plus, the S&P is up about 21.6, and gold's up a little over 20. So over the last 12 months, not only have you seen the S&P continue to do well, but gold has continued to march along with it. And we've seen it do its job in periods of dislocations, and we've seen it participate in the rising markets. So I wanted to set that tone and really get people's expectations and understanding about what we're seeing in the market over the last couple of years as a way to start thinking about gold as a true core allocation. And so what I'd like to do now is really shift gears and bring John Hathaway into the fold and talk about gold as a core allocation and really highlight gold as an evergreen asset, a liquid asset, a true alternative when you look at its return patterns, and as I mentioned, as a potential replacement to your bond and core allocation in your portfolio. So with that, I'd like to now bring John on the line and have John address the audience with what are we seeing currently in the market today? Has this become a new breakout in the market? You know, what's got you excited about the gold trade today after being in the industry for north of 2 decades now?
Okay, Ed, thank you very much. Thank you all for being on the call. I'll just make some brief remarks. First, on slide 17, it's a little bit out of date, but gold has broken out from a 6-year basing pattern after having performed very well in the previous decade. And so in many ways, and for many people, it's kind of in the penalty box. It is kind of off limits in terms of client portfolios, but we just want to make the case that it should be otherwise. We're now well over 1,600, so this chart's well, I guess it is pretty current. In my mind, it would not be far-fetched to think that gold could better its previous high in 2011 of $1,900. We're not that far away from it, and the forces that are driving it, I know right now on everybody's mind is coronavirus, but and I don't really want to speak about that, but I think that's kind of the headline that's driving it, at least in the near term. But much more important than that is the fact that interest rates remain very low. And when we look at slide 18, you can see that the correlation with low interest rates and gold prices is very tight. And what happened last September when the Fed had to step in to support the repo market and resume quantitative easing, gold really, after having corrected during the previous couple of months, took off again, as did the shares, mining shares. And it's very hard to imagine that in a world with 240 trillion of debt, public and private, that a 1 or 2% rise in interest rate wouldn't be very, very damaging to financial asset valuations. And so it seems reasonable to expect the floodgates to remain open in terms of liquidity creation, and that, as I've just tried to make the point, is very, very good for gold. And if we just flip to the next slide, you can see that investors are beginning to return. This is for gold-backed ETFs, physical metal. This does not show you what mining stocks are doing. And frankly, last year, despite the fact that the Sgdlx, which is the best proxy for gold mining stocks, was up 40%, it had net outflows. And that suggested to me, and I think should suggest to everybody, that there's still a good deal of skepticism in terms of the sustainability of this move in gold prices, which I think is very, very healthy. It is very typical of an early stage bull market where skepticism is the dominant mood. So I would say that it's still early days, and mining stocks, frankly, and Doug will be talking about that in a second, are still laggards, even though they're up substantially if you look at the last couple of years. Finally, let me just point out that central banks have been buying gold at a record pace. This is on slide 20. In fact, they are buying 20% of global mine output. So when you think about the supply and demand of gold, gold mining output globally is actually starting to decline, yet central banks are buying at a record pace. And that has a lot to do with the dynamics of the pricing and the price outlook. Again, central banks need to have their reserves in a safe place, and they're choosing gold over U.S. Treasuries and other sovereign debt. So with that, let me turn it over to Doug, who will talk about the specifics of gold equities.
Sure, and Doug, what I'd like for you to hit on, thank you, John, for that. Doug, what I'd like for you to hit on really is we are seeing, to our point that gold continues to show promise given the current market environment. Talk a little bit about gold as a tactical allocation, particularly in a favorable, precious metals market from a price action standpoint, and what that means from a margin expansion standpoint, from an M&A standpoint, and really also talk about that value discrepancy we're seeing, and not only gold to gold equities, but also the separation between the large cap senior miners to the small cap junior miners. So if you can really walk us through that over the next couple pages and really talk about kind of what you're seeing in that environment. Let's talk about mining stocks in general being really undervalued right now on page 22. What does that really mean to you? Why do you think we're seeing that?
Sure. Thank you, Ed. Thank you, folks, for joining us today. I think there's a number of different things that are very important in terms of the dynamics here in the marketplace and the opportunities for investors in this market. One is that, as John mentioned earlier, we're coming out of a 6-year basing period. And if you look at basic material sectors, you'd note that over time, over the long-term horizon, there can be 11-year or 7-year type of cycles that occur. And we're actually coming out of that type of cycle now, and the fundamentals are real positive from a number of fronts. The cycle had a downturn in the last decade because of poor capital allocation, high costs, the miners overbuilt. But towards the end of the decade, they really realigned themselves, reduced their costs, they improved their balance sheets. They did not focus on new projects the way they did in the early part of the decade. And as a result, we're seeing shorter mine lives, which are real positive fundamentals for higher pricing and better margins for the marketplace, for the miners. But also we're seeing another dynamic, and that is mergers and acquisition activity. Over the last 2 years, a number of mining companies who had not done exploration and had not been able to replace their resources have been really going to the financial markets to add to their asset base. And we saw a number of significant M&A transactions last year with the merger of Barrick and Randgold, as well as the merger with Newmont and Goldcorp. And then subsequently, towards the end of the year, we saw a number of mergers come together. And typically, when you see these type of large mergers take place in the marketplace, it is a sign of a bottom in the market, and really projects that the opportunities going forward are really quite more significant for investors paying attention in that regard. In particular, the value discrepancies are quite significant in the marketplace, and we can look at, I believe it is page...
Yeah, on page 23. Yeah, let's talk about that for a second, because I think that's something that a lot of people aren't really focused on, right? I mean, the S&P has done so well that most investors aren't looking around for other ways to allocate capital. And if you're looking for an attractive buy today, I mean, man, there's few other charts out there that look as attractive as the gold equity chart relative to the S&P. Talk about this a little bit, because as you had mentioned, a lot of these mining companies have cleaned up their house, as it were, from a balance sheet standpoint. Yet that inverse correlation is one of the largest gaps we've ever seen. And not that we're calling a bubble in the S&P, but boy, it's got a pretty hard climb here. And the differential in return patterns of the S&P relative to gold mining stocks look pretty attractive. So can you talk a bit about that?
Absolutely. And if you look at the turn of the century, you'll see that while the S&P was doing quite well, the basic material sector, the gold stocks were not doing very well, and a very large gap in terms of valuation evolved there. But subsequently, the market recognized the opportunity in the precious metal space, and in the first decade of the century, gold stocks did very, very well. They, I think Ed pointed out earlier, they outperformed the S&P on a broad basis. We're seeing the same dynamic occur now. As the sector went through that downturn in the last 6-7 years, the S&P outperformed, but now we're really in a position where we can see the valuation opportunities, and the market is beginning to recognize that too. However, the market has not fully appreciated that opportunity. And let me just try to run through a couple numbers here a little bit. If we look at the gold price of today, $1,600 an ounce, and we think about the cost of production at about $1,000 an ounce, that's a $600 margin. And if you look at, say, $1,500 an ounce gold and $1,000 cost, that's a $500 per ounce margin. You see that as the gold price goes up from $1,500 to $1,600, that's maybe a 5 or 6, 7% type of move. But you would see that your profits go from $500 to $600 an ounce, which is about a 20% expansion in terms of your profit. So there's significant amount of leverage that has yet to be appreciated by the marketplace. And if you look at page 24, you'd see that the market has really discounted the opportunity over the last 10 years, but now is just beginning to recognize that. And we saw, while the gold price was up about 18-19% last year, the market started to revalue these gold mining equities. They rose about 35-40%, but clearly not fully valuing the opportunity over the long term. And I think there's another dynamic too, is that as these companies mine out their assets, they need to replace them, but they have not been able to replace those resources over the last 5 or 7 years because they were capital constrained. And thus we went into this M&A cycle that has been accelerating over the last year and a half, and we expect that to continue. And as part of that cycle, we recognize, if you go to page, say, 26 or so, you'll see that, to my comments earlier, mine lives are shorter because there has been a lack of replacement, and yet gold production has been relatively steady but cannot be sustained at these mine lives and with the resource base that's currently in place in the industry. And if we look at page 27, here's further support of our argument that it's actually more attractive to go out and buy or do an acquisition or merge with another company as opposed to try to build a new mine. And that has been, behind the merger with between Newmont and Goldcorp and between Barrick and Randgold and other mergers we saw last year. One of our larger positions in the fund, Detour Gold, was acquired earlier this year by Kirkland Lake. Here too, Kirkland Lake was looking at replacing its mine life. Kirkland Lake Gold had a mine life from its assets of about 5 or 6 years. The acquisition of Detour Lake Gold, with its mine life of about 25 to almost 30 years, extends the overall portfolio for Kirkland Lake. And that was an important development, I think, in the marketplace for investors to recognize that in order for these companies to carry on their operations, they need to add resources, and buying right now is the preferred opportunity for a number of the companies.
And Doug, I want to bring up one point that you just mentioned about the buy versus build. Even if Kirkland Lake had a new discovery tomorrow, right? Let's say they discovered a new site tomorrow and a new place to dig. What kind of time frame are we talking about before that thing can even get online? I mean, what's the realistic time frame by the time they make the discovery to get approvals and go into production? What kind of time frame are we talking about?
Well, it's quite a long time. It can be 7, 10, 12 years. And not only is the discovery made, but then you have to go through the definition of the ore deposit. Then the company has to get the permits and the social license and the approval from regulatory authorities. They have to go out and raise capital. They have to build the mine. They have to purchase the equipment. This can take, just that part of it can take 7 or 8 years. And if there's delays along the road, it can be a 10-year type of project. So it's very time-consuming to bring on new assets. And I think an important element about the gold sector is that gold deposits are not typically huge deposits. Gold is a precious metal. It's precious because it's rare. It's rare because it's not found very easily. It's found in remote locations. The size that's found is not typically very large. So it's very difficult to replace these resources. And with the time element, it becomes even more precious.
Yeah, and I think that's a good thing for people to walk away with, because so often people think, oh, well, what if we get a new discovery tomorrow? Won't that change the kind of buy versus build mentality? But you're talking a decade or another market cycle or two before those mines can actually go into production and have it be meaningful to the bottom line of those companies. So I do think that M&A cycle is something that we're going to continue to see become more and more prevalent, particularly the larger caps, as you've seen and we've all seen the last couple of years really consolidate, particularly the larger caps going in to the small caps or the juniors. And I think this next page really sort of gives you a couple reasons to be excited about the mid to small cap space, not just from the M&A standpoint, but talk about it from a value gap standpoint. Sure. This surprises even me. These are really apart.
This is interesting because I think this presents the opportunity, and this is what we're doing here at Sprott, is that we're seeking situations where junior miners who are not getting the valuation in the marketplace for whatever reason. It might be because the market doesn't believe their ability to raise capital, or they don't have the scale to execute effectively. Their valuations are suffering, and yet the larger cap names, the senior producers, who maybe do have more liquidity and more recognition in the marketplace, are getting a higher valuation. And it presents a fantastic opportunity for investors who are informed and aware of the dynamics in this market to participate in the junior segment of the market with the expectation that value will be realized either by external forces, by market dynamics, or from within the industry where senior producers are looking to replace their resources. And, again, Kirkland Lake's takeover of Detour Gold is a great example. Kirkland Lake became a major market cap stock over the last couple of years with the success of their mines, but recognized that they really had to extend the life of their operations and thus acquire the Detour Gold assets and extended their life span as a result.
Yeah, and I think that this next page really hits that home. We're seeing more and more, I almost go as far as say household names, people that aren't even investors that aren't even focused on the gold and gold equity trade. I'm even surprised many people know the name Barrick and Newmont and even Goldcorp. But as you go down, further down that realm, I think active management in particular in this space is really important. But also just really trying to identify particular names that we think can create value, whether it's through the price of gold rising or through value creation through management, cost cutting, consolidation, technology, and so forth. I know, after this call, I know you're heading down to Mexico to see a mine that we currently own, as well as to look at a mine that we may be interested in owning. And I think that really hits home to what we do day in, day out. But is there anything on this page that really jumps out at you or that you'd want to point out that could really be or should be highlighted as this M&A cycle really has truly begun, and we think it's going to continue to be quite robust for the foreseeable future?
Well, I think it's the chart here, the depiction that there's been a number of values over the last year, but we could see a couple years of deals here in the sector. The industry is in a much better financial shape than it was some years ago. 8, 9, 10 years ago, the companies leveraged up their balance sheet. Now today we're talking about companies that have no debt, they're cash generating, significant cash at this $1,600, $1,550 gold price environment. And I think it's important to recognize that we've only gotten to this price level in the last 6 to 8 months. Mm-hmm. So these companies are not quite used to being cash rich. And right. I think the broader marketplace has not really registered to recognize and said, hey, these guys are in a different position. I think the industry did itself a disservice by growing so aggressively, 8 years ago, loading up its balance sheet with debt. But now those balance sheets are in really good shape, and there's fewer projects out there. So they do really have to go out and do acquisitions. And, I think the bottom sample transactions really shows investors that it's across the board, whether it's the large producers like Barrick or Newmont that are making acquisitions, or smaller ones like St. Barbara, which is an Australian company, or Evolution, another Australian company that's come to North America. Both St. Barbara is Australian, as is Evolution. They've come to North America to acquire assets. So we're seeing it on a global basis. Yeah. It's not just a North American phenomena. It's other countries are looking for resources around the world.
Well, and I think that's something that so often people have started to adopt the gold allocation, but they're still very cautious about the gold equity trade. We've certainly seen it at the institutional level, but at the retail level, we really haven't seen investors embrace the gold equity trade. So I think hopefully people will walk away from this this webcast today with some more insight into how to think about both gold as a core, but more importantly, gold equity as a tactical or opportunistic allocation over the coming years. John, I'd like to come back to you for a moment and really talk about the outlook. Everyone likes to talk about price. We're not going to pin anybody down on what price we think we're going to see. But on page 30, we do highlight a couple bullet points that we think really highlight the right conditions for both gold and what that means for gold equities. So, as you mentioned at the start of the call here, we broke through 1,600. Seems to be holdings over 1,600 today. Don't want to get caught up in short-term pricing, but if this price shows some stability and maybe it pulls back, maybe it doesn't, what do you think the outlook looks like for gold over the next, say, call it 1 to 3 years?
Basically, gold cycles last for more than just a couple of years. The first one, or the one in most recent memory, began in around 2000, and gold went from roughly $300 to $1,900, or a six-fold increase. I would say that we are in the second, maybe still the first inning of this next run. The forces, the macro forces that will drive it are the huge amount of debt outstanding, as I mentioned earlier, 240 trillion, and the fact that if a 1% rise in interest rates would, which is a tiny amount to think about, would topple the valuations of financial assets, and it would cripple the global economy. So the central banks are caught in a trap that they can't get out of. They're forced basically to continue to print money. We haven't seen it yet in inflation, and of course financial asset valuations are very high. If you do an analysis of the S&P, most people think the multiple is 22 times earnings, but it's actually 31 if you weight the components of the S&P according to the market cap of the various underlying securities. So I think my view is that the one thing that hasn't kicked in yet that I think would drive more and more investors into gold and gold mining shares is a setback in financial asset valuations. We have yet to see it. As Ed mentioned earlier, people are quite comfortable with their mainstream strategies. If that were to change, I think you would see a huge change in sentiment, and gold would be one of the big beneficiaries of that. So I think it's early days. I think the outlook is very bullish, and it's certainly not too late to think about adding that exposure.
Yeah, John, I think to your point, we got a little mini preview of that in the fourth quarter of 2018 when the Fed said, we're on autopilot, we're going to continue to raise rates, all's good in the world. And the broader world realized, I don't think so. And the market sold off pretty significantly, and it took quite a while to come back. Now, certainly the S&P is on a nice tear again, but I think it's why you see over the last 12 months both are returning right around 20% because of that sell-off. And so I do think if we saw an S&P pullback of any kind of significance, that pent-up demand that's been slowly percolating up at the institutional level will, I think, filter down or filter into the retail and individual investor level. And so I would agree, of course I would agree, but that we do think that there's early days on this trade still, or this investment, and investors should be considering, at a minimum, gold as a core allocation. Now, having said that, Doug, I want to turn back to you for a minute because, the gold equity story, as you had mentioned, about earnings accelerating, what other points would you want the listeners today to really walk away with as it relates to why should they think about gold equities today? And if they do, is it large cap versus small cap? Is it, multi-properties versus single property? Like, where should they be focusing their energy on if, in fact, someone's going to look at gold equities?
Well, I think the better valuation proposition right now is in the mid-caps of the smaller cap names. A couple points I'd make is that right now companies are reporting their results for 2019. And as a general statement, the results, the profits, the earnings are much better than expected by the overall consensus in the marketplace. And the reason they're better is because analysts have been reluctant to raise their gold price assumption, given the rapid rise in the gold price over the last year. A number of analysts are still using $1,450 or $1,500 gold price in their models, and yet here we are at $1,600 an ounce. And I think, we look at the sector and we run models on a regular basis. If you do that, you would recognize that the gold stocks are really valuing a gold price of about $1,500, $1,475. And so really the market is behind the curve here in terms of valuing these stocks properly. And that's really where the opportunity is. And the better valuations are in the mid-cap, smaller cap, though the large cap too are not reflecting this type of gold price environment. And we talked a lot about the M&A cycle, the M&A opportunity. That's part of it. But really, the bottom line here is the earnings that these companies can generate with this gold price. The market's not there yet.
And I'd be remiss if I didn't talk about the actual allocation itself, because that seems to be, as we've done these over the year and as I've met with clients over the years, typically the number one question is, okay, I hear what you're saying about the gold allocation. Let me sit on the equity allocation and think that through a little bit. But also what it comes back to is how much, right? How much should I have in this? And, the true gold believers, they would say 100%. But in the real world, where we all know you need dividend-paying stocks to grow your net worth and so forth, what percent seems to make sense from an allocation standpoint? Is it 50, 30, 20? Like, what's a realistic allocation? And Doug, you had an experience recently when you were converting over your 401k. We talked about this actually when you left Tocqueville and came to Sprott. And even in that process, when you went through your risk dynamics, gold was recommended, which was even to a surprise to us. So, what have you typically seen in an allocation that you think is enough to matter, but not too much to have you bet that the house is going to burn down? What's a number that makes sense to you?
Well, I think 5% is a good allocation. And let me just share the story that Ed was mentioning. I came over to Sprott recently. I started a new IRA account at Schwab. And it's a robo account where it asks for my profile, it asks for some information, my level of risk that I'm comfortable with. And automatically, even before funding this account, it gave me an allocation of approximately 2% in gold. And I did not ask for that. They did not know I'm a gold investor, but they gave me an automatic allocation of 2% in gold. It was about 3% in cash. The rest, about 60% or 65% in equities, and another 30-35% or so in bonds. But what struck me was that it was an automatic process, that I was allocated gold without even my indicating an interest. So clearly there's an understanding out there that gold adds a lot of value to a portfolio and is essential for a long-term investor in order to maintain value in that overall portfolio.
Yeah, and I was happy to hear that, and also a bit surprised to hear that as well. And we've done a lot of work over the years with World Gold Council, and I think a lot of the allocation comes back to what your stock bond, what your risk on, risk off allocation is. And I think if you go above 5%, that's where I think the conversation should be had with us as a firm on where should that remaining 5% go to if you're going to get, say, a 10% allocation. And so I think a combination of both gold and gold equities would be appropriate in that environment, particularly in the landscape we sit in now. So, what I'd like to leave everybody with before we go into the Q&A session is really, again, just to go full circle here on the suite of offerings we have. So as John Hathaway talked about the physical side of the market, Sprott has a full suite of core solutions that allow you to own in a very liquid way that trade on the New York Stock Exchange direct ownership of physical gold, silver, and even platinum and palladium. And so I encourage you, for those that want to allocate to the physical side, to reach out to us and learn more about how we can be your core allocator for the physical metals. In addition to that, we do offer both large cap senior through SGDM and small cap junior through SGDJ factor-based ETFs that go above and beyond simply market cap weighted ETFs. So we've taken some of the factors that have mattered in our active strategies and we've applied those to a more passive type of approach in the gold equity market. So for those that want just a standard allocation to the space, we have some solutions that can provide that for you. And then lastly, our flagship fund, the Sprott Gold Equity Fund, Sgdlx, is our active strategy, which allows you to get true active management predominantly, is it fair to say, kind of more in the small cap or mid to small cap space, where we are really looking for some of the greatest opportunities out there in the market. And there's one unique thing that we highlighted on this page as well, on page 32. What's unique about our gold equity fund, is that it has up to 20%. Currently, it's around 15% in physical gold. So you get kind of a one-stop shop within the active portfolio. So what I would encourage most of you to do that are on this call today or on this webcast today, at any time you can certainly reach out to me. My direct cell number is on here, the 646 number, as well as my email address. But we also have senior investment consultants based around the country, both on the East Coast, Midwest, and West Coast. And I would encourage you to reach out either to myself or them and allow them to really advise or consult you on how to think about the space, not necessarily drive you down one solution or another, but really help understand how you're allocating currently, what your client's allocation looks like, and allow us to really work with you on creating a diversified portfolio and using gold as part of that diversification. So with that, I will stop on the product side, and I'll turn it back over to Natalie, which, Natalie, I'm surprised to see, I'm looking on the live questions coming in. We have 44 questions right now, which I think may be a record for us. So I don't know if that's an indication of having John and Doug as my guests today, or if it's a byproduct of where we are in the market. But nonetheless, we have 45 questions. So we're not going to get to them all today, but I will promise you that between myself and my colleagues Matt, Julia, and Sergio, we will all get back to we'll get back to everybody on all these questions in the next week or so. But Natalie, I think we have about 5 or 10 minutes to address some of the top questions today, so I'll turn it over to you.
Great, and thank you all for such an informative presentation. As a reminder, a copy of today's presentation, as well as additional material, can be found in the Documents folder at the bottom of your screen. We appreciate your feedback. Please take a moment to fill out our brief survey, also located at the bottom of your screen. Our speakers will be taking advisor questions. Please type your question in the box to the right of the slides, and we'll get to as many of your questions as possible. In the event your question is not answered on today's webcast, a member of the Sprott Asset Management team will reach out to you directly. And if you'd like to have a conversation to further discuss the ideas that were covered during today's event, please click the one-on-one folder at the bottom of your screen and confirm the request. So with that, let's go ahead and take our first question. So the first question reads, would you discuss holding ETF or mutual funds with mining stocks versus the metal itself? So if the metal, what venue? So coins, 1 ounce bars, and if coins, which ones?
Sure. As I mentioned a bit on our product suite, it really depends on you, the investor, what you're trying to accomplish. I think if you're an advisor and you're allocating to both gold and gold equities for multiple clients, I think the direct coin or bar solution is probably not appropriate because it can be very hard to track and see how that allocates and how that works within your overall portfolio. So I do think you should look at a suite of offerings, whether it's through our trust. As I mentioned, we do have a very unique trust that allows you to own the physical bars directly. They're held outside the U.S. For U.S. investors, there's a tax advantage a potential tax advantage to the way your long-term capital gains and so forth are treated. So we can certainly advise you on how to allocate to the physical side. And then as far as the equity side, whether it's ETFs or mutual funds, that's going to come down, I think, to the advisor, how cost conscious they are from a fee standpoint. We would say, and as Doug sort of alluded to as well, as you go into the mining space, certainly not buying individual mines. You certainly want to own a basket of mining stocks. So trying to cherry pick one name or another, I think, is a wonderful way to lose a lot of money very quickly if you get the wrong name. Having said that, as you go down in market cap, and we do believe that right now the mid to small cap space is the most opportunistic space to look at, you really want to be thinking about it from an active management standpoint. So we certainly offer that through our Sprock Gold Equity Fund. There's other peers out there that do it as well. Selfishly, I'll say you need to be looking at what Sprott does and how we do it, and given our track record and our focus, you really want to be thinking about an active approach. And Doug, I don't know if you want to add anything to that.
I do have something, a comment. I outlined earlier the profit opportunity and the potential with the change in the gold price. And, I indicated that at $1,500 an ounce, these companies make $500 in profit. At $1,600, they make $600 an ounce. So there's a significant amount of upside potential, but there is a lot of risk here. There's a lot of risk from an operating perspective, from a location, from a management perspective, capital perspective. And I think for investors, it's important that they have somebody that's involved in the process to understand those risks and to direct capital to risks that are appropriately valued and where there is true upside in opportunity. An ETF, an equity ETF, will just select names. They won't know exactly what they're investing in. They'll just invest in an equity issuer. I think it's important that investors recognize as much as there's upside, there's risk, and I think active management is a way to mitigate some of that risk in the space.
Thank you. Yeah, I would agree. Natalie, what else we got out there?
Absolutely, thank you. So the next question reads, why do central banks invest or hold gold?
John, I'll turn that one over to you, but before I do, I think it's interesting. We've been dealing more and more with some private families in the last year or so. Some have come to us unsolicited, and some we have discovered through our travels. But my favorite quote from one of the families is they're looking at physical gold as part of their allocation to be their own central bank, which I thought was a really fascinating way for an individual investor to think about that core allocation. But John, maybe you touch on it a bit. Why do central banks hold gold relative to some other assets that are out there?
Well, I mean, gold is a super safe asset. It's the safest in terms of counterparty risk. There is no counterparty risk. Anything else you would talk about, and anything else that central banks would own, have some degree of credit risk, whether it's U.S. Treasuries or Euro bonds or what have you. Gold is highly liquid. It trades 24/7, very narrow bid-ask, and they own it because it's a cornerstone of safe assets that is the mandate of central banks to have.
Thank you. And Natalie, I'll actually just address this because I'm seeing the questions come on my screen as well now. One of the other questions that just came in is the gold to silver ratio. That's something we get all the time. But I think the bigger part of that question might be, which isn't being asked, but I want to point out, is the gold to silver ratio right now is about 88. So 88 ounces of silver to buy an ounce of gold. The longer term, I call it the midterm average, has been around 60 or so. Either John or Doug, if one of you guys want to jump in on this, how important is that? Really, people ask me all the time about it, but I feel like silver is becoming more and more of a commodity where gold is a true financial asset as far as the way people invest in it, i.e. central banks and so forth. How important is that gold to silver ratio today?
Well, I think it's a metric that people use. Silver is a precious metal. It often occurs with gold in nature. But silver has industrial uses that apply, and so there are dynamics in the economy that drive industrial supply and demand that are a little bit different from gold, which really is very much a monetary metal. And it is possible we could see a reversion back to that 60 type of ratio. Is 88 the right ratio? I don't know, but I think there's dynamics in the marketplace that have forced gold to be higher value than silver. But we've noted in the past that when silver performs, it can have a significant impact and perform quite dramatically over time.
Yeah. And Natalie, how about another question then? I think I was going through a couple of other ones, but what other questions are coming up that might be of interest?
Absolutely. So the next question reads, do you recommend GLD, GDX, GDJ, or SLV? I would recommend none of those because those are on our funds. But all kidding aside, there are different ways to think about the space. So the GLDs of the world give you exposure basically to spot price. And for some people, that's enough. Other people, other investors, particularly institutions and families that we deal with and high net worth individuals, they want to truly allocate a portion of their capital away from the financial markets.
So, John, you've been doing this for over 2 decades. What really is the difference? Why should someone think about sort of effectively the paper market versus the physical market as it relates to owning gold? Why is that important to a high net worth investor?
Well, owning an ETF that's backed by gold, such as GLD, is convenient. Sprott has physical gold trusts, which offer the same convenience and the possibility of buying at a small discount to the spot price. So there's some attraction there, favorable tax treatment. But for those investors who are looking for more dynamic exposure, shares are the answer. And we've talked about ETFs of shares, Sgdlx being the most prominent. And that's fine, and it's done well over the years. We believe that actively managed portfolios are the better approach. The Sgdlx is very heavily weighted to 4 or 5 different holdings, which you could easily buy for yourself: Barrick, Newmont, Agnico, Franco-Nevada, etc. Maybe are 40% of Sgdlx. What we offer with active management is exposure, and Doug talked about it, to the hidden opportunities that can outperform the large cap stocks substantially in a rising environment, which is where we are. So if you're looking for dynamic exposure, shares are the better way to go, and within that, the best way to go in terms of upside potential would be an actively managed portfolio that actually focuses on mid to smaller cap names.
Thanks, John. And Natalie, I think we're almost up to an hour, so I think we have time for one more question. And as I mentioned, and I'll put this slide back up as well, the slide on the territories. As I mentioned, for those that we didn't get questions to today, we would certainly welcome you to reach out to us, but we will also be going through all the additional questions and reach out to you in the next coming days, whether it's by phone call and or email. But how about one more question just from a time standpoint, and then we'll sign off.
Great, absolutely. So the final question reads, will you invest in mines around the world regardless of location, or stay away from certain countries due to geopolitical risks?
That's probably a good one for you since you're heading to Mexico this afternoon.
Right. That is very important for us in terms of our analysis, where a mine is located, not just in terms of political aspects, but in terms of access, infrastructure, whether a mine has access to power and water and a labor force, and is accessible with regard to supplies. And joining Sprott, it was actually rather refreshing, I think, for John and I, where we recognize that Sprott has a more developed assessment of political risk than we had been used to. And it's been a real, I think, enlightenment for us as we go about looking at opportunities in the world. But we certainly are aware of the challenges that mining companies face, whether it's a regulatory challenge or maybe a social challenge with regard to the local community, or perhaps on a national level. So we're very much aware of that. That directs our investment process. There are countries in the world that we're not inclined to invest in because the rule of law and the respect of land ownership is not recognized.
Excellent. Thank you. Well, I think that's it for our time, Natalie. I'll let you wrap it up. And again, thank you all for joining us on the call today. We look forward to reaching out and having further conversations. We all travel together and individually throughout the country, throughout the year at conferences and one-on-one meetings. So for those that are interested in working more closely with us, we welcome the opportunity to meet either by phone and or in person. So thank you.
Thank you, folks.
And thank you again for joining us today. As a reminder, a copy of today's presentation as well as additional material can be found in that documents folder at the bottom of your screen. Also, this will be available for replay, and all registrants will receive replay information by email once it becomes available. I want to thank you all and hope you have a great rest of your day.
Thank you.